$10 million was spent on each of the 6 different bonds. The year was 2005, and everyone thought he was crazy. He predicted the US mortgage-backed security that was once a stable and reliable investment is now a ticking bomb, and it was just a matter of when. But his bet was no gamble. But by the time the rest of the world would notice, it would be too late. It took until the 11th of October 2007 for the S&P 500 to top out at 1,576 points. A year and a half later, on the 10th of March 2009, the S&P closed at just 676 points, a 57% crash. He ended up making a personal profit of $100 million. His investors were also safe in his ark, amassing over $700 million in cumulative profits from his single bet. He's the physician that doubles as an investor and hedge fund manager. He's Dr. Michael Burry.
I called up the prospectuses and I read the prospectuses and I looked at these pools. I could see the credit standards within these pools deteriorating, just quarter to quarter.
How could you tell that?
There was essentially crappier mortgages being put into these pools.
But in the years leading up to this amazing success, Dr. Burry received constant criticism from the investing world and even his own investors, criticism that ultimately led him to close his fund after all had been said and done. But why do we mention this now? After all, this was 15 years ago. Well, you guessed it. History is currently repeating itself. Just as he was the one to see that something was seriously amiss in the burgeoning subprime mortgage market, he's also making dire predictions for this fiscal year and beyond. Michael Burry originally forewarned of significant inflation as a result of the Fed's massive money printing back in February last year. He was tweeting about getting ready for inflation using the hashtag Doom to Repeat and criticizing the Federal Reserve and the US government for their $1 trillion stimulus program at the time. He was the contrarian. But everything appeared to be going according to plan, you know. The Fed was printing money, yeah, but the inflation remained low at the moment. The most recent data available indicated an annual inflation rate of only 1.7%. That's less than the federal government's goal, but in typical Burry form, he was simply early. Again. 1 year later, we're currently experiencing an inflation rate of 8.6%, and Michael Burry believes the worst is yet to come. He predicts it would be so bad that the S&P 500 could lose another 50 from where it sits today. On May the 3rd, Burry tweeted regarding paradigm shifts and speculative peaks. The S&P 500 bottomed 13% lower than 2002's bottom in 2009, 17% lower than 1998's LTCM crisis low in 2002, and 10% lower than the 1970s low in 1975. Going centuries back, it was 15% lower than the covered low S&P value of 1862. Roughly, it'll appear to be 16% nominal P of 9 in historic range, but what he's nothing is the trend we've seen over the past 25 years. The bottom of a current market crash usually lower than the one that came before it by about 10 to 15%, adding that 15 below the S&P low that we saw in 2020 takes us down to 1,862 points. That's crazy, because it shows that Michael Burry is anticipating a peak to trough fall of 61.4%, which would bring us back down to the historical normal Shiller P of roughly 16. Michael Burry projects a further stock market decline of more than 50%. The market has risen by 6.5% over the past few weeks, but as far as we've seen over the past few days, short-term bounces don't necessarily mean we're out of the woods, and Michael Burry actually commented on this potential scenario. It is a bold prediction that was once again met with criticism. He recently tweeted, quote, Dead cat bounces are the most epic 12 out of the top 20 Nasdaq one day. Rallies happened during the 78 drop from the 2000's top 9 of the top 20 S&P 500 one day. Rallies happened during the 86 drop from the 1929 top. Again, that's a lot of numbers to wrap your head around. But what he's alluding to here is that even during the worst times, the statistics show that it's actually quite common to see strong short-term recoveries amongst the longer-term downward trend. 12 of the top 20 Nasdaq bounces happened along this slope. 9 of the top 20 S&P 500 bounces happened along this slope. On the 5th of May, he added, quote, "After 2000, the Nasdaq had 16 bear market rallies over 10, averaging 22.7, before bottoming out 78. After 1929, the Dow had 10 bear market rallies over 10, averaging 22.8%, before bottoming down 89. So, Burry certainly seems confident that we're simply in the early stages of a much bigger problem. And to further his point, he also took the time to comment on the comparatively low trading volumes we've seen during the 2022 downturn this far. Withdrawals from the markets haven't even really started. So, in Burry's eyes, we're likely going to see a lot more selling volume coming over the next few years, which would lead to much larger declines in the stock market. And it's a scenario that he said he's not looking forward to facing. On the 24th of May, he tweeted, "As I said about 2008, it's like watching a plane crash. It hurts, it's not fun, and I'm not smiling." And that's the interesting thing to remember with. Michael Burry claims to have witnessed all of this before, first during the dot-com bubble, and then again in 2008. He has repeatedly observed these recurring patterns in human behavior, and he has researched the excess and greed that led to the most significant booms and busts. I believe that this is what gives him such assurance when he discusses these issues. He tweets about them, and he just shared this white graphic on Twitter, which I found to be pretty illuminating. The 10-year S&P 500 run-up is shown in yellow, followed by the dot-com bubble run-up and the run-up prior to the Great Depression. It's pretty scary how similar they are, and Michael Burry comments on this saying, "Third time's a charm. Gotta love human nature. Nothing if not consistent." You know that this pattern of human behavior is familiar to him because he has seen it often and knows where it leads. He tweeted that he had just witnessed the biggest speculative bubble of all time by 2 orders of magnitude just a year prior. It may have reached its breaking point in his eyes now, but the stock market is simply a market after all. We must keep in mind that the economy is, of course, the main justification for Burry's viewpoint. We already know Burry's views on inflation, and it's true that the Fed is raising interest rates to make it more difficult for businesses to borrow money. However, it's important to keep in mind that rising interest rates also have an impact on consumers, who are the basic pillars of the economy. Knowing that more of their savings and income are going towards paying off debts, consumers, unfortunately, have less money to spend in tough inflationary settings that result in significant interest rate increases. This typically triggers a downward spiral because, ideally, lower discretionary spending results in lower sales for the businesses in which we have investments. Burry has made hints that the current state of the consumer market isn't great. Personal savings decreased to 2013 levels, the savings rate to 2008 levels, and revolving credit card debt increased at an all-time high, returning to its pre-coverage peak despite the trillions of dollars that were dropped in their laps, which were accompanied by the threat of a consumer recession and additional earnings difficulties. Burry is plainly concerned about the shrinking of savings, since it not only encourages individuals to use credit cards more frequently in a climate of rising interest rates, but also because it results in less spending, which affects the bottom line of the companies in which we have investments. You know, one anecdotal piece of evidence Burry mentioned lately was the Q1 revenue figures from Amazon, as reported by CNBC, who stated, quote, "Revenue at Amazon climbed 7% during the first quarter, compared with 44% expansion in the prior year. It is the second consecutive quarter of single-digit growth and the slowest rate for any quarter since the dot-com implosion in 2001. Burry also published this tweet in response, contrasting US personal savings with GDP. As you can see, the savings are covering less and less of America's GDP at a point where America's GDP is shrinking. So overall, in Burry's opinion, yes, we have inflation, interest rate hikes, reduction in consumer savings, thus less discretionary spending, which ultimately leads to lower profitability of businesses and what we've seen thus far, re-ratings on their stock. Dr. Michael Burry is infamous for deleting his tweets, but we know he knows more than he's letting us on. Do you think Burry is right with his stock market predictions? Drop your thoughts in the comment section below. Don't forget to like, share, and subscribe to our YouTube channel so you don't miss out on any of our videos. See you next time. Bye.